Hello and welcome to our Refinance Your Property video. My name is Ian. I'm the franchise owner for Mortgage Choice in Charmhaven. When people ask me what I do, I often reply with, I help stop people donating money to banks. And chances are you're watching this video because you may well be one of those people. So today I'm going to walk you through some basic information about refinancing. We'll look at what difference refinancing can make to your household budget, address the falling property prices and what that may do to your refinancing options, and the steps you need to take today to make the most of the competition being created by the banks fighting for your business. Look, we're all feeling the sting of inflation. Prices for just about everything seem to be going up, and a lot of it is simply out of our control. Remember when hamburgers used to have iceberg lettuce instead of cabbage? Those were the days. Anyway, your home loan is probably your biggest household expense and potentially the one thing that you could be saving the most money on with very little effort. Have you had your current home loan for more than 18 months? Has your fixed rate period recently finished? If so, the simple fact is this: you are almost certainly paying a rate which is higher than what is otherwise available on the market today. Even if you're on a fixed rate at the moment, but it will finish in the next few months, you need to start planning your next move now. But first, let's address the elephant in the room: property prices. Reports and statistics show that property prices are dropping across the nation. Does that affect your ability to refinance? Now, these reports don't show us that prices are dropping. Now, hear me out. What they actually show us is that property prices had dropped in the previous reporting quarter. Now, these reports often also provide a prediction on what will happen going forward. And aren't predictions about real estate and finance from experts so handy? Like, home prices will crash thanks to COVID-19, and rates won't go up until 2024. Anyway, let's take a look at the PropTrack report released in August 2022. These figures I'm showing here compare the market to the start of the COVID-19 pandemic, plus the difference since the peak of prices, for which a lot of the country was towards the end of 2021. And yep, a majority of the country has fallen from that peak hit. Let's take a look at Sydney, who's had the biggest drop, down 3.5% from the peak. But let's look at Adelaide and the rest of South Australia and regions in WA and good old Northern Territory. They're still at the peak. Now take a look at the comparisons since March 2020. Sydney is still up 26.9%. Outside of Sydney, your prices are up by 51.7% and are less than 0.5% off the peak. Even Brisbane and Hobart are still up over 48%. Now look, there's little doubt that prices are falling. In the market, there's more stock, it's taking longer to get a sale, interest rates are going up so people can't borrow as much as before, and prices may very well continue to fall. But let's not lose sight of the big picture. If you did not buy during 2021, has your property actually gone down in value? Highly doubtful. So is there going to be a problem when it comes to refinancing your home? At the moment, I'm yet to see any evidence that there will be. So with that in mind, why should you look at other home loan options regularly? The answer is simple: interest rate. The product and the amount of discount available when you got your home loan has probably changed as the banks fight for new customers. Bigger discounts, better products, They're all introduced to incite new customers, which you, as a loyal customer, will usually not be offered. This can potentially cost you tens of thousands of dollars. Really? Take a look at this. A $600,000 loan was taken over a 30-year term on a variable rate of 5%. Monthly repayments are ticking along nicely at $3,221 per month, and 2 years later, the loan balance is down to $583,000 with 28 years to go. During a home loan health check, it is found that another lender is offering the same kind of product, but for 0.5% less, or 4.5%. A refinance to this lender over a 28-year term to retain the same remaining term would make the monthly repayments $3,055 per month. That's a reduction of $166 per month. Or, to make a typical bank ad or a catchy screen grab for an online video, $55,776 saved over the remaining term. Looking at the cost side of things, we'll assume there are establishment, discharge, and government charges, usually to around $1,000. Unlike a purchase, a conveyancer is not required. So in this example, it would only take about 6 months to claw back the costs through the savings. And that's excluding any cashbacks that the new lender may be offering. Now, if you're thinking about debt consolidation as part of a refinance, stop and listen carefully. Consolidating debts like a car loan or a credit card balance, which are on a higher interest rate, may mean the debt is now costing less per month and is on a lower home loan rate. But please do not attempt a debt consolidation yourself. If you do not set up the debt consolidation properly or choose the right lender, you will end up paying more than you should, potentially even more than before the debt consolidation. Always speak to a mortgage broker about your needs, goals, and objectives for the debt consolidation, and let the broker guide you through the process and structure a plan and home loan accordingly, as lender policies and flexibility around debt consolidation does vary enormously from lender to lender. Finally, you may be thinking about accessing some of your equity to renovate your home or go on that trip of a lifetime. You may even have enough equity to use as a deposit for an investment property. Accessing the equity for personal use is a great time to compare what's in the market. Don't just apply for a top-up through your current lender and presume you'll get a good deal. So is now the time for you to get serious about refinancing? And if so, what are the next steps? Firstly, call your bank. And yes, I'm a broker. And yes, my advice is to call your bank. Why? Because they may offer you a discount on the spot with no hassle and no cost. You can start saving money with a simple phone call. But even if your bank does offer you a discount, then the next step is, after accepting the discount, to contact your mortgage choice broker. Don't just presume that because you've got a discount that you're now back in line with the rest of the market. But you might as well take advantage of the discount while we compare. And remember, always choose a broker with a large panel of lenders, ideally at least 30. You can review their credit guide to see what lenders they're accredited with. Don't just check their website. This way, you can be sure your broker is comparing a large portion of the market, not just a select 15 to 20. A broker will be able to meet with you at a time and place that is convenient, in person or remotely, provide you with a range of options and recommendations based on experience and facts, and they will process your application and deal with the lender so you don't have to. They'll be your own personal contact through the life of the loan, and the service comes at no cost to you. And did you know mortgage brokers are bound by law to look after your best interests? Your bank is not. It's little wonder that over two-thirds of home loans written in Australia last year were through mortgage brokers, and that number is growing. My name is Ian. I'm from Mortgage Choice in Charmhaven, and thank you for watching this video.